Good day, and thanks for joining us for our Ag Outlook webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me today on the webinar are my colleagues, Dr. Chris Hurt, Professor of Agricultural Economics, and Dr. Michael Langemeier, who's the Associate Director of the Center for Commercial Agriculture and also a Professor of Agricultural Economics as well. Before we start today, I wanted to make you aware of a program that we've got coming up in just a few weeks. The Purdue Top Farmer Conference will be held here in West Lafayette on Friday, January 11th at the Beck Agricultural Center here in West Lafayette. And then we'll have a pre-conference the day before on January 10th. If you're interested in attending, I'd encourage you to tap into our website, purdue.edu/topfarmer, where we've got the detailed agenda and the registration information. So check that out if you have an opportunity and have some interest in attending the conference. I wanted to start off talking a little bit about how we got where we are. And this is from our Ag Economy Barometer project that we've done jointly with the CME group in Chicago, where we survey 400 farmers nationwide and every month. And at the end of our monthly survey, we give those producers an opportunity to make comments on any topic they choose. And this word cloud summarizes what we found in the January 2018 barometer survey, where people were focused heavily on things like regulation. Obviously, prices are always of interest to producers, concerns about taxes, immigration, and a little bit about trade, as you see in the center of the slide. And then I'm going to fast forward a few months to the November 2018 slide and notice the change. And clearly, the dominant factor that people have been worried about recently in agriculture is trade, especially trade with China and the impact that that's having on the U.S. agricultural center. So with that kind of starting point, Chris, let's kind of think about what's taken place. And you're going to look at the corn balance sheet and talk about the changes. USDA just released that last week. So give us a bit of an update and a little bit of insight into what that 1920 balance sheet might be looking like, because you've got some projections on that on the slide for that as well.
Well, that's right, Jim. And again, we'll look at corn first and soybeans just a little bit later. Let's start with ending stocks. That's next to the bottom in terms of the rows. And what we see from our ending stocks is the 16 crop, we're about 2.3 billion of carryover stocks. 17 crop down to 2.1, not a huge amount of reduction, but tightening of stocks. And then the current estimate for the 18 crop is that we'll be down to about 1.8 billion. So what we're seeing here is a continuation of progress towards getting our inventories or our storage stocks in better alignment, to get supply and demand in better alignment, and to have stronger prices as a consequence of that. Now, when we think about where is this reduction in inventory coming from, is it because we've had poor yields? And the answer is certainly no. 4 of the last 5 years have been record high yields for U.S. corn and U.S. soybeans. So it's really not yields, it's not acreage, it is the growth of usage. Usage is at near record levels in all the major categories for this marketing year. The 18 crop will market into 19. And let's just look at those. Feed and residual, 5.5 billion bushels of usage. We'll go down to the ethanol at 5.6 billion bushels of usage. Again, that would be about the same as last year. What we see so far this year in terms of ethanol is that the margins have been very narrow. In fact, probably a number are losing money. They're certainly not covering their total cost. They're all their depreciation and overhead cost. So I think it does make, and the reason for that is energy is relatively abundant, gasoline's relatively cheap, and if gasoline is cheap, ethanol is probably going to be cheap as well. And so those narrow margins, I think, do give us reason to believe that we may not set new records on ethanol, corn use for ethanol this year. Exports, again, very strong this year, 2.45 billion bushels. Again, we have real opportunity now with our large inventory to be aggressive selling in the world, and that looks very positive. So when we look at the total supply, we look at the production in the 18 crop, 14.6 billion bushels, second largest crop ever on corn. The good news is we're going to use more than that. We are going to use all of this second largest crop ever and more and bring that carryover down. USDA is using a $3.60 price for a U.S. average price, a marketing year average price for corn in 18. Again, we finally see some recovery in those prices off of the last 2 years. Now, it's time to start thinking, obviously, about 2019 crop and the 19-20 marketing year. So we've put some numbers over in the right-hand column, at least a first shot at thinking about what those numbers might look like. We're going to increase acreage, 3 million acres on corn. Again, that's going to come out of soybeans. And there's still a lot to be determined of just what that number will end up being. We're going to go with kind of a trend yield of about 176.5 bushels. Remember, that's down from 178.9 for the 18 crop. That was record high yields. So that gives us a crop of, with the higher acreage even and some lower yields, 14.9 billion bushels. And at this point, we would be projecting that we will see usage, total use, be up over 15 billion, so that we'll draw those stocks down somewhat more. And I debated whether to say 380 or 390, so I decided to get a little more optimistic and go with 390 for an average price. Again, this is a U.S. price. Indiana prices tend to average over time about 15 cents higher than that. So Michael, that gets us back to around $4 corn, which as you look at your costs will be interesting to at least think about.
Yes, we'll show that later, but right now the break even on high productivity soils right at $4.
Okay. So that's kind of a number I know you've been asking farmers to look at in terms of an objective to try to get their cost structure into that $4 or lower. And now it looks like we have the possibility that the market supply and demand factors are going to help us get a little bit of boost in those prices and get a little get prices closer to cost of production. So the bottom line on corn is usage is really strong. We've had these high yields, and you stop and think, what happens if we get back to normal yields or then have some kind of weather problems, South America in the next 2, 3, 4 months in terms of corn or soybean production? Or what if we have one of these usage categories that's higher? You do have a bullish scenario potentially getting formed in corn.
Yeah, you do. And I think the other thing, Chris, as I look at that slide is the wild card going forward here over the course of the winter, and probably the number we're going to debate a lot is going to be the acreage in 19.
Absolutely.
You've got a shifting from 89.1 to 92 million acres, but I think that's kind of a wild card at this point. And we're going to talk more about that on the soybean side here in a few minutes.
A lot still that will happen to determine what that acreage shift was going to be. What does the market need next year?
Yeah, and we'll see some evolution with respect to prices. But it's really interesting as I look at those ending stocks projections. You know, in that 16-17 crop year, we were up at 2.3 billion bushels, and now projecting potentially in the ballpark of 1.6 to 1.7 billion at the end of the 1920. That's some real progress.
Yeah, and that's without any shocks, limited yield potential, et cetera.
And I think if you go back to that 16-17 time frame and told people that we were going to have these incredible yields that we've had the last several years and still be able to pull down the ending stocks, I think most people would have been skeptical of that.
That says there's been a responsiveness of end users to these corn prices. These corn prices have been in the last several years low, and it's really stimulated usage.
They've been very attractive from a usage standpoint. This looks at the ending stocks to use ratio graphically.
It tells us a contrast between corn on the blue line, which we've just talked about, and what we'll be talking about in a few minutes, and that is soybeans. Now, soybeans are on the red line. Again, what we're looking at is the ending stocks as a percent of use. So it's another way to look at our storage inventory, how much excess do we have. And what we see on corn is that what we've already talked about, the usage has been extremely good. Yes, we've had lower prices, but it's really stimulated usage, and we've brought our carryover stocks down from 14.5% on the blue line down to 11.8% projected for this 18 crop. Now again, running my projections on out for 19, as I said, we're looking at dropping that inventory somewhat more, and we're not back to 2010 11 and 12 low inventory levels, but certainly we're making a lot of progress, and that says higher prices if we continue to move in that direction. Now let's look at the contrast while we're looking at this visual, and that is the red line, and particularly the red line for 2018, when soybean stocks mushroom up to 23% of use, ending stocks as a percent of use. Again, this goes back to 2000, and that's the biggest inventory by far as a percent of use that we've had here in the United States. Soybeans, you're just looking at that, you say soybeans are in real trouble. That's a lot of inventory, and it's going to be hard when you get inventory that high to work that inventory off in 1 year in the 19 crop. You would be saying we've got multiple years, at least 2 years, the 18 crop and the 19 crop, of lower soybean prices. So there's a lot of dynamics in that visual, and as you've already talked about, Jim, in the Midwest we can shift easily between corn and soybeans, and so the dynamics of how much shifting is going to be partially dependent on what happens to events like weather in South America, to trade events with China, how many beans we're going to be able to export them, and then that adjustment of less soybean acres going over to corn, the magnitude will be determined in the next 3-4 months.
Yeah, and a lot of farmers throughout the country have already made some preliminary decisions about what they're going to do for 2019, but there's going to be some adjustments take place over the course of the winter as people respond to the changing price ratios. Yeah,
and what I think we say to that is there's more uncertainty because of the soybean export uncertainty that we have this year than we have in most years. You always have uncertainty about which acres to plant. So I think that suggests as a strategy, producers try to maintain a little more flexibility to not commit to the inputs on all of their acres. Now again, that's hard to do in many cases, but to the extent they can remain flexible on some acres, I think that would be the strategy to follow.
Yeah, I agree.
Beans in trouble, corn looking pretty good here.
Yeah.
This corn price chart, this is the March corn futures, and when we think about what level should we be thinking about pricing, I think we look at this $3.90 to $4 on the March futures as some historic levels that the market has gotten to in the last 6 months. And again, with the size of crop we had, with the carryover we have, I think that's about as much as we can anticipate on the high side of corn prices until we have something else, supply or demand, that could cause us to go higher. So the way I would tend to think about this in terms of pricing is we're not quite to that $3.90 point, but I'd sure like to be, maybe even have some orders in at that $3.90 to $4 on the March futures to do some pricing on this rally. And again, each individual will have to make decisions about how much they hold on to. But I think the next upside potential, maybe some unfavorable weather in South America as an example, that gets you up to maybe $4.20. And so, Michael, here again, if we can get $4.20 futures, we're backing up to something around $4 in terms of cash prices, at least at ethanol plants and processors. Not quite there yet,
yeah,
but
a little different than 2-3 years ago.
Maybe we've got a little rally potential based on some events. We're not sure what those will be. So one of the things we look at is when do you price? And our first thought would be $3.90 to $4 on the March futures. And then your next level is probably that $4.20 on the upside. But remember, there's downside as well. There's still plenty of inventory out there. And our trade negotiations with China will have some impact on corn as well.
Chris, you've taken a look at storage returns,
right,
and let's think about that for just a minute because those are pretty interesting as well.
Yeah, so here we have some mid-Indiana bids on corn, and we've got December, January, February, March out through the storage season. Now again, what we want to say is that each individual needs to look at their buyer to see what their bids are, to see if they have sufficient premiums for later delivery to continue to store. What we have here again is on this location they had a bid of $3.76 for December, and go out to July, $3.93. So premium bids for later delivery. The other straight line on there just starts with December at $3.76, adds a penny of storage. And again, each individual producer would want to evaluate whether they can store foregone interest for a penny a bushel a month. But put your numbers in for that. Let's go out to July, I believe, gives us a premium of 10 cents above interest cost. So for on-farm storage on corn, if I were going to price today, then I might choose to price today, but for delivery late next spring or summer, if those premiums are sufficiently high to cover my interest cost for on-farm storage.
And Chris, just for clarity, how you generated that blue line, you took that $3.76.
Today's price and said it's going to cost me something to continue to store on farm, and most everybody has some opportunity cost on their capital, on interest. So use whatever the appropriate rate of interest is.
And for a lot of us, that would mean, we would take that $3.76 and use that, for example, to pay down an operating loan. And so you might take that annual operating interest rate divided by 12 to come up with a monthly rate.
That's right.
And then just
add
work
that
through
on.
the math.
Yeah.
So that's where the blue line comes out. And the interesting thing there is the gap between that blue line and the bids out there is pretty substantial, more so than we typically see.
Well, and again, I think the bottom line is if I can pick up another 10 cents a bushel above the cost I have in storing for longer times, that's a pretty substantial additional return to your storage space on the farm. So I know there's things like cash flow. I've got to have money. I have to sell now. But looking at these premiums and taking more return, getting as much return for your storage as you can is the strategy we want to follow.
Yeah, and we've been talking about that. Most people in the Corn Belt, especially here in the Eastern Corn Belt, did everything they could to store as much of the crop as they possibly could last
We've
fall.
We've stored it, so let's get all the value
let's
we can out of that storage.
Let's see if we can generate some return, exactly. Michael?
I think when you're storing more corn or soybeans than you typically store, one of the things you really need to keep in mind is communicating your marketing plan with your lender. Make sure he understands why you're not necessarily paying down more bills. You're doing it because you're going to try to get a higher price later on, and so I think that communication is important.
All right. Let's move on and talk a little bit about revenues here. And you've done some projections actually on a per acre basis, but then also looking at the impact on a state level basis here in Indiana.
Yeah, I just trying to come up with some ideas of how are revenues going to come out, and we're working towards obviously income. How does income come out? So let's start with corn in the 17 crop and comparing that to the 18 crop. And again, we're using Indiana state data here. So in 2017, corn yields in Indiana were 180 bushels. This is above trend. Would probably be 172, 173, something like that would be trend yield. So good yields above trend, 180. But this year, 2018 crop, 194 bushels. We look at Indiana prices. Last year, Indiana prices averaged $3.56 a bushel for the 17 crop. This year, USDA is talking about $3.60 national price. Let's add 15 cents to that to get $3.75. And then I've got the first trade assistance payment of a ½ cent a bushel on all your bushels. So that comes out $3.75.5 for this year's crop versus $3.56 last year, with yields 14 bushels higher. The bottom line for us then is to look at the middle. The revenue per acre is $88 higher on average in Indiana. Now, Michael, I think you had cost up some in 18 versus 17. So if we're trying to net this out and get a little closer to an income.
Costs were up some, but they weren't up very much.
Well, let's take $8 off. That gives us $80 an acre. And again, we're just trying to do back of the envelope scratching here. But if you have $80 an acre more return than the 17 crop, the acreage is down there in the box, over 5 million acres. That's about $400 million more return on corn. Then we look at soybeans for what we have up here. 54 bushels, again, low 50s probably would be where we'd think in 17. So I had strong yields, but record yields in 18 is 60 bushels. The price of soybeans was this is Indiana price, $9.61 for the 17 crop, drops to USDA's using $8.60, and Indiana tends to run over time on average about 20 cents higher, so we'll put that at $8.80. And then I have the first trade assistance payment of half of $1.65 as 82.5 cents. So when we put the trade assistance in there, we end up with a $9.62.5 price, slightly higher than the price we had for the 17 crop. Just following through on these numbers then, the revenue per acre is about $59 higher. If we take something off for say $8 or $9 for higher costs, just to give us a little adjustment there, $50 more per acre times almost 6 million acres, there's $300 million more dollars there. So you look at 400 million more net income on corn, 300 on beans, that's $700 million. That compares to a total income in 17 of 1.6 billion we have right at the bottom of the visual there. Now that's substantial, and just this week then the announcement that the second payment is going to come for the trade assistance, and that of course it will be corn and beans, but the big one for the country is soybeans. So that in Indiana, 60 bushels times 82.5 cents is just short of $50 an acre. $50 an acre on 6 million acres approximately is another 300 million. So when we look at this with trade assistance, with the high yields, and with especially strong yields on corn, we're looking at $1 billion here of more income coming out of the 2018 corn and soybean crop than the previous year. That's a substantial amount of money when total income in agriculture in Indiana was $1.6 billion, and we've got $1 billion extra dollars above those levels. Now that's going to get split in 2 years, that $1 billion. Some of that's going to be sold, some of these corn and beans will be sold in 2018 calendar year and some in 2019. Historically, about half the beans from the marketing year crop from the 18 crop are sold in 18, and about half the beans are sold in 19. In corn, it's less, 40% sold in the year of harvest. So we'd say this year, guessing historically, 40% of the corn gets sold in 2018 and 60% gets sold in 19. So this is going to get spread over 2 calendar years. But I think this is reason for some optimism. If you're a lender, if you're an input supplier, if you're a farm family, those are really, really good returns. Now, we're not going to be back to over $3 billion of annual income like we had during the good years, but this is a substantial improvement from 1.4 to 1.6 billion we've seen over the last 3 years.
And Michael, as I look at those numbers and think about the impact, that probably explains why we've seen, at least based on some of the anecdotal reports we've picked up from auctioneers this fall, there's been some positive impact on the land market?
Yeah, certainly these numbers would suggest stable to slightly higher cash rents and land prices.
Yeah, and that's what we're picking up anecdotally when we talk to the various auctioneers here in Indiana and throughout the Corn Belt. So that's very consistent, I think, Chris, with what your income projections are
I think there's some
suggesting.
optimism that wasn't there for really the last 6 months or so once we got into the trade conflicts. It's been a pretty bleak psychological period for agriculture.
And the 390 corn also is probably higher than what some people expected, so that's positive too.
Right.
And let me mention, I should have talked about new crop corn. We, I think, have a possibility as we go through the winter to look at some rally on new crop corn up to 4 1/4 on futures for December 19. So I think there's a mark to be looking at, thinking about, and that gets us up near the cash price of $4 a bushel.
That's right. Well, let's shift gears and talk about soybeans, because the picture is not quite so bright on the soybean side, at least going forward.
There's a lot of numbers and interesting things to talk about on soybeans. And of course, the focus has to be on the 18-19 marketing year, second column from the right, and the ending stocks just absolutely mushrooming to up near 1 billion bushels of carry-out. Now that's 1 billion 955 million's the number, but that's nearly 1 billion bushels of soybeans from the 18 crop that at the end of August of 19 will not be sold, will not be used, and will be carried into the 19 crop in September and October. That's a phenomenal number. That's huge. The problems are two. One, we had a lot of, on the production side, we had a lot of acres of soybeans, and then we ended up with record yields on soybeans, 4.6 billion bushels of production. And then exports, USDA has marked those down to 1.9 billion, and the uncertainty is certainly large. It's not just China, but China is the big part of that uncertainty of how many bushels we may be able to sell them. And that's continuing to be a mystery at this point. We'll have to see how that evolves. As I run those numbers with a 955 million bushel carryout, I think you could see prices in the low $8. You know, that's really a huge carryout. It's kind of unprecedented. You know, how do you know the impact of something that hasn't occurred? So again, USDA is at $8.60 a bushel. Let's go over to next year, and sort of the guess would be, as I've already said, it's hard to get out of this kind of a hole in 1 year. It usually takes multiple years when you get this kind of an inventory build up. Again, I want to go back to 18-19 and say there's still a lot of uncertainty of how many bushels will we be able to sell in the export market. And we'll talk about that a little bit more later. But anyway, looking next year, and here we're going to drop the soybean acreage sharply, over 6 million acres less soybeans. Going to drop the yields from the record 52.1 down to 50 bushels per acre. That gets that crop size down from a 4.6 down to a 4.1 billion bushels. So that's a very big adjustment right there. And then our carryover stocks building back exports, and again we'll have to see how that goes, but still gets us up around 800 million bushels of soybeans. Some improvement in price, but sub $9 for soybean prices. So a lot still to be determined, and we'll give you a few ideas on these next visuals how this is evolving with China.
Chris, as we indicated earlier with the corn, one of the big debates is going to be the acreage function going forward here over the course of the winter. On the last couple of Ag Economy Barometer surveys, we've actually asked people that grew soybeans in 2018 what their plans are for 2019. And when we asked that question in October, I think 19% of the people that grew soybeans in 2018 said that they were going to plant fewer soybeans next year.
Right.
We asked that same question again in November, and 30% of them said they were going to plant fewer soybeans going forward. And then we went one notch further to get a little handle on how much of a decrease we might see, and we asked people that told us they were going to reduce soybean acreage in 2019 by how much. And roughly 2/3 to almost 70% of them said that they were going to reduce soybean acreage by 10% or more.
Oh, a large amount.
So the people that are looking at this, I think, are looking at some significant shifts, and that's going to play out. We're going to continue to ask that question going forward to get more information, but that tells you that we're looking at a big shift, and you've got a big shift on the screen there, but who knows at this point, right?
And the shift is both corn and wheat.
That's correct. Yes. That's correct. We haven't talked about wheat, but more acreage to wheat. And winter wheat probably already have more acreage, but then spring wheat. Will be in that mix when we really see corn, soybean, and wheat prices.
And we did ask people that plan to plant fewer soybean acres next year what crop they were going to devote those acres to. And as Michael was kind of indicating, roughly 2/3 of them said that they were going to plant corn on those acres. So that'll be the big shift, but it won't be the only shift, right? So
now there's going to be a lot of dynamics, a lot to be determined. As we all know, our negotiations with China are going to be key in that. And the other thing that always can be an influence is weather in South America. If they have lower corn or soybean yields, that can really influence that decision here in the United States of what acreage is needed in the world.
Well, speaking of China and speaking of exports,
let's
take a look. Let's take a look.
So here we've looked at the sales of soybeans so far this marketing year, and there's weekly reporting data. And so this is as of December the 6th. So yes, China has bought some soybeans in the last week. Those would not be reported yet on this information. But we're looking at the decline in Chinese soybean purchases, 772 million bushels decline. And there were a few, and I heard one representative from the administration say that, well, if China doesn't buy the beans, the rest of the world will buy the beans, so it'll all work out okay. Well, let's look at, is that statement holding at this particular point? And this was, again, the first week of, as of the first week of December. And so you can see where the other buyers have been. Europe has increased their purchases versus last year by 100 million bushels. Argentina by 66 million. Non-Chinese countries by 58, Mexico 55 million bushels. We can look at down in the shaded box under the graphic in million bushels, China's bought 772 million less bushels. The rest of the world hasn't even come close to compensating for that. They've bought an additional 305. So total purchases down 467 million bushels for this marketing year. And we can look over on the right-hand side under percent there. And total sales so far this year on soybeans are down 33%. We're down a third. USDA at their 1.9 billion bushels is down 11%. So far, China not buying beans is a huge detriment. And if you were projecting that we're going to stay down 33% for this marketing year, there could be a lot of trouble for soybean prices going forward. Now again, China has bought some beans in the last week. But let's talk just a little bit about China again. So China's sales are down 98%. They bought 2% of what they did last year at this time. China threatened that they would find a way to do without U.S. beans, and up through at least December 6th, they largely have done that.
Yeah, so Chris, it's really interesting to me to look at the USDA forecast down 11%, and yet what's taken place so far this year down 33%. So going forward, there's going to need to be some catch-up.
That's right. And again, it's still early. This is September, October, November, and the first week of December. We already know we're going to sell some beans to China. So there's going to be some catch-up, but we'll have to watch these numbers as we go week by week.
Yeah, it's just a very volatile situation, and the idea that you can forecast it accurately is unfortunately just not true.
I think that's right. And this brings us back. We've got some, I think, reasonable pricing opportunities on beans right now, given these numbers that we're working with. And we want to be cautious of thinking that there's no downside in this bean market.
Right.
I think there is downside. If the Chinese-U.S. negotiations break up, which has been largely the pattern we've seen so far, there's probably a pretty big downside on soybean prices, especially when you think that's going to be early March when the breakup, when we can't get the negotiation. South American beans are going to be coming to the market, and China's going to be able to say, we just don't need any more of your beans at all.
Right, right.
So plenty of things to be concerned about on beans.
So speaking of those soybean prices, there's been a shift in what's taken place with respect to Brazilian prices versus U.S. prices, and you've got a chart here that I think is fascinating.
Oh, it is, very much so. The blue line is the price of soybeans at a Brazilian port. So this is beans moved to the ocean, ready to load on vessels to go out to the world. The red line is, say, a New Orleans or U.S. Gulf soybean price. The time period is goes back this year, 2018, so we start the first week of January of 2018. We're just looking at the prices of those two locations ready to go on ocean vessels at the Gulf of Mexico or at the Brazilian port. And you see those are reasonably the same or fairly close to the same up until we get to June when the tariffs, knowledge of the tariffs come on. And then we see generally strength in soybean prices in Brazil and weakness in the United States. And of course the question is, well, what makes a U.S. bean so less valuable? Well, the big buyer in the world, China, has a tax of 25% on U.S. soybeans, origin soybeans, and so that makes them less valuable. On a roughly $10 a bushel soybeans delivered to China, 25% tariff is $2.50 a bushel. And that spread between Brazil and U.S. Gulf, interestingly, at its widest level, got out close to that $2.50. And I think that's what we would expect. U.S. beans are less valuable in the world, have lower prices, and this gives us then understanding of some of the behavior we've seen. Europe bought more beans. Why did they buy more U.S. beans this fall? Well, look how cheap U.S. beans were compared to Brazil. Why would China pay such a high price for Brazilian beans? Well, because the alternative was U.S. beans, but they had to pay the tariff on those, and that raised them $2.50 roughly. So I think it explains a lot. And then final thing, we'll say Argentina. We saw them buying quite a few more beans. Argentina produces beans. Why would they buy from us? When that spread was wide, they sold, and look at those numbers on Brazilian beans. Those get up near $11.50 on Brazilian beans. They sold theirs to, Argentina sold their beans to China and then bought U.S. beans and paid the transportation for them to crush in Argentina. Now, part of the fascination of this visual is to look at the very right-hand side and to see what's happened in the last about 6 weeks or so.
And actually, to do that, maybe let's look at the next slide, because that maybe makes it just a little more clear. So this is the same data you had before, but now we're just expressing the difference between those two price series, the Brazilian and the U.S. series.
Right. And so there we see at the widest spread, Brazil soybeans were about $2.45, close to that 25% tariff at the widest, and that was kind of our peak harvest in the middle of October. And since that time, we've seen that spread revert back to more what we expect, and that is there wouldn't be a lot of difference between Brazil at the port and U.S. Gulf ports. So that's an interesting phenomenon. Why is that? Well, one hypothesis is that Brazil has largely sold their soybeans. So if China or anybody else wants to buy soybeans, they have to buy from the U.S. now. Another hypothesis is that now China is going to buy U.S. beans under whatever agreement has been struck between the U.S. and China. And they're primarily going to buy, the government's going to buy soybeans. So it turns out they're going to buy U.S. origin soybeans. They're going to pay the tariff on the U.S. soybeans. The Chinese government will.
But who do they pay the tariff to? That's the key point, isn't it?
They're paying the tariff to themselves. So essentially, if you are paying a tax and it goes in your bank account, there is no effective tariff on that. Then China's talking about allowing some private crushers to buy some beans. And the word in the marketplace is that they will ask the crusher to pay the tariff. And let's just think of that as an extra $2.50 a bushel. They have to pay the tariff, but then the government will rebate that tariff amount back to the crusher. In other words, there is no effective tariff on those bushels. So this is another argument that basically, if you don't have the tariff working, or if the government pays the tariff and it comes right back to them, you shouldn't have a differential between U.S. origin and Brazilian origin. Now, when does this break down? It breaks down, let's get out to early March. If we don't get an agreement with China to hopefully do away with this 25% tariff on soybeans, if we don't get that and our trade negotiations break up, then as Brazilian beans come back available for the market and U.S. beans are available, this spread could widen out again. And what does that mean? U.S. bean prices go down relative to Brazilian bean prices.
And that's your downside scenario on
There's
soybeans.
Downside, and that's March.
Yeah.
Or whenever those trade negotiations break up.
And I think as I look at the chart, Chris, and you were talking about your scenarios for why that gap has really narrowed, it's probably a combination of what you just said.
I think that's right.
And then especially when you look at the last few weeks, it's probably this government scenario where the Chinese government is effectively eating the tariff. But
it was really just December 1 when the presidents had an agreement that they would buy some U.S. beans.
All right, let's...
But markets do work.
Markets do work.
Markets give incentives. This just looks at the bushels of beans that we actually ship to China. Sep, Octave, Dies going through the marketing year. And as you know, is very logical, China buys U.S. beans at our harvest time. So let's look at October, the peak export month. Last 2 years, previous 2 years, 16 crop and the 17 crop are the red line and the blue line. And in October, these are actual shipments. We shipped China 250 to 300 million bushels of soybeans. You can think of that roughly as equivalent of the whole state of Indiana's production that we're shipping to China in 1 month in October. There's a few entries down at close to the zero line, 2.5 million bushels that we shipped them in September this year and 10 million in October. So there's your 2%.
Yeah, those numbers were so small we had to put the text on there so you could see them, right?
You know, you just miss that. And again, it's back to this concept that China said they could do without U.S. beans. They would find a way to do that. We all knew they'd have to buy some beans, but it does make a U.S. bean farmer really nervous to see how effective they were at doing without U.S. beans, at least for a while. We have a shaded box here, the reported 90-day agreement. And again, this has never been made public that I know of. This was Bloomberg reporting this a few days after the presidents met. Chinese government would buy about 185 million to 300 million bushels of soybeans. That's 5 to 8 million metric tons is what the agreement we understand was. And they'd allow the private sector to buy an additional 75 million bushels. So again, this could get us up to close to 400 million bushels we would be selling China on this trade deal. Those announcements have started to come through last week. I think there will be a number more of those announcements, but there's nothing official yet of just exactly how many bushels are in this agreement over the next 90 days. And I think our president has suggested March 2 as the deadline at the end of that 90-day period.
And Chris, when I think about those quantities, those sound pretty good, but there's nothing guaranteed about it.
That's basically 1 month of shipments that we had been making to China, and we've missed September, October, November, and December. So that does not begin to compensate for the lost sales that we've had so far.
And they're not guaranteed.
That's correct.
All right, let's take a look at the futures.
Yeah, so I come out here looking at the rally we've had since early November, coming off of that 850 low, getting back to the 920 here on March futures, and look at the 920 to 940 as sort of the top side once we got into the tariff concerns back in June and early July. As much as you could expect with this uncertainty that we have in the marketplace on just what we're going to sell. So I'm a big believer here in doing some pricing. Some want to get some beans sold before the end of the calendar year. A lot of storage. Many have a very high percentage of their beans stored. Take some of this rally right now. Now again, what is the argument for saying, no, I'm going to hold and I'm going to get a better price? I think the argument is that there is going to be a grand bargain negotiation with China, and that we are going to see China willingness to make considerable concessions, and in that agreement will be a willingness of China to buy considerably more U.S. goods. and there will be an agricultural component to those goods. That's a fairly substantial amount that they guarantee they're going to buy from the United States. Now, will that happen? Will that not happen? I think that's kind of what we're betting on will happen, and I wouldn't want 100% of my beans bet on that's going to happen. I'd like to take some of these prices right now.
Yeah, because if you look at it, we've had a pretty substantial rally since our fall low. We actually penetrated a little bit below that 850, and now we're at that roughly 920, 923, 924 range. So take advantage of that on at least a portion of your crop that's in storage. And if you want to choose to speculate on a positive outcome to the China-U.S. trade situation, and perhaps obviously some potential for production problems in South America, which would obviously be bullish as well. You might choose to do that, but this is a big enough rally so far that you take that along with the market facilitation program payments.
It's a great year on soybeans.
Yeah, and don't let that get away,
and
at least.
Our recommendations were heavy soybeans. It's going to work out, it looks like now. That is going to end up being a good decision. And again, the $1.65 is important on the market facilitation trade assistance program. Okay, returns to storage, doing the same thing on soybeans. Looking at Central Indiana bids, 862 in December, going out to 910 in July. So we go look at interest, then I use 4% interest, the horizontal line, and that works out to be 3 cents, about 3 cents a month of interest. Let's go out and look at July, 883, today's price plus my cost of interest foregone, and I could sell at 910 and when I check these bids, so 27 cents of premium above interest cost for on-farm storage. So getting another 27 cents out of your grain bins, that's a substantial additional return for your grain bins. If I were going to sell beans today, I have them on farm, I'm going to sell them today, price them today, I might price them today, but for delivery on out into the late spring or summer. And again, each farmer wants to look at their bids and how that works at their buying locations. What about commercial storage? If we had 3 cents of commercial storage per month, let's go out to July. That would be 6 months of storage to get to July the 1st. So that'd be another 18 cents. We can pick up 27. That's a net gain of 9 cents a bushel. So even commercial storage looks like people should be checking to see if they can get enough return for pricing today but delivering later to cover all of their cost.
Yeah, so it's a real opportunity, even more so on the soybean side than on the corn side.
And this is very unusual. We rarely see this kind of premium prices being bid on beans as you go into the spring or summer.
But it's what you would expect given the magnitude of the carryovers we have, where the marketplace has provided a financial incentive for people to continue storing.
And let's be cautious mid and late summer, next summer, on holding beans that deep into the summer, because there's going to be a massive amount of beans carried over, and you have to depress old crop relative to new crop to give enough incentive for the commercial grain industry to buy those beans and keep them in storage. So basis could really get wicked bad again mid and late summer on soybeans.
Yep. All right. Michael, let's talk a little bit about cost of production.
Yeah, let's compare rotation corn and rotation soybeans. First of all, this is using trend-adjusted yields for high productivity soil using the 2019 Purdue Crop Cost Guide, which is available on the Center for Commercial Agriculture. And so looking at rotation corn, we're looking at a break-even price right at $4. That's pretty good compared to Chris's forecast of $3.90 corn. Soybeans, not so good. We're looking at a break even. It's a little under $10 there with trend adjusted yields, but that's quite a bit higher than the prices we're looking at for 2019. And so we're really seeing a switch here between which is more profitable, rotation corn or rotation soybeans. For the last several years, specifically from about 14 to 18, at this time of the year, when we were looking into budgets, soybeans looked relatively more profitable. This year, it's really similar. And you add to that the fact that we have a lot of uncertainty related to soybeans. It makes this decision much tougher than it has been for several years.
And I guess the other thing I was thinking about as I was looking at your slide, Michael, is the fact that going back roughly, say, 4 years, we are looking at lower production costs than we were looking at, for example, in 14, 15.
Oh, definitely. Yeah. Corn back in 14, for example, was closer to 450 on high productivity soil, and even higher on average to below average productivity soil. Soybeans was over $11, and so we've taken a lot off of our cost of production. There is a couple wild cards for 2019. Fertilizer costs appear like they're going to be higher compared to what they were the last year or two, but not enough higher that we're going to be back to our break-even prices we saw several years ago. And also cash rents are more stable, perhaps increasing a little bit rather than decreasing like they have the last several years.
Yeah, I just think it's interesting, though, to point out that we are seeing a convergence take place here as these cost of production numbers have come down gradually over the last roughly 4 years. And we have a scenario where we have the potential to see, especially on the corn side, see revenues actually approach what those production costs are.
Getting closer.
All right, so you've taken a look a little more closely at the corn-soybean situation. This chart's going to look at soybeans compared to continuous corn.
Now this is for Indiana and using our budgets again, and it's very important to note here. I've looked at the relative cost between corn and soybeans, but I've also looked at I'm using trend yields, and so that's a very important point to make. We're not looking at yields like we saw the last 2 years for corn, for example. We're looking at trend adjusted yields, and so I've said using the relative cost, using the relative yields. And using a particular soybean price, what would corn need to be, a minimum price for corn, in order to encourage more continuous corn? Let's start at $9. That's a little higher than Chris was talking about earlier. But at $9 on high productivity soil, corn would have to be $4.11 per bushel or higher. And so if we're expecting $9 soybeans, we're not expecting a lot of continuous corn in Indiana. However, as Chris talked about, there's quite a bit of an uncertainty to soybean prices. If you look at something like $8.50, then the higher productivity price for corn would need to be $3.95 or above. That's getting closer to where the price that Chris was talking about. And so in Indiana, we're not necessarily expecting a lot of continuous corn. But certainly this looks much different than it did last year, for example. Much closer.
And it certainly argues for people going back towards more of a 50-50 here in the Eastern Corn Belt.
We had 700,000 more acres of soybeans last year than we did corn. You'd expect much closer to 50-50 this next year.
Here in the Eastern Corn Belt.
And particularly given this particular slide. Now we're looking at second-year soybeans versus rotation corn. And so we look at that $9 soybean price again, go out to high productivity soil, corn would need to be $3.76 or above. Well, that's certainly possible for corn to be $3.76 or above. So rotation corn in particular looks really good right now compared to second-year soybeans. So much closer to that 50-50.
And then you've taken a look at the relationship between corn and soybean acres across the Corn Belt, which is kind of
let's think a little bit wide, a little bit broader than just Indiana here. If you first of all look at the Indiana number here, for the last 2 years, we've had more soybeans than corn. That's only occurred 4 times since 1973. So we're in a very unusual situation right now compared to where we have been historically. But another thing that's very important about this chart is when you're thinking about shifting acres from soybeans to corn, you focus more on the Western Corn Belt because Iowa tends to have more continuous corn, and that's what this chart is showing you in the black line there. Iowa typically has more continuous corn year after year, and so it's much more likely we're going to see shifts in more continuous corn in Iowa compared to Illinois, Indiana, and Ohio.
Yeah, so if you look at the Indiana, Illinois, and especially Ohio situation, it's probably going to be a function of shifting back towards a 50-50 split.
More rotation corn, less second-year soybeans in Iowa and Nebraska to some extent. It's going to be looking at more continuous corn.
All right. So as if we didn't have enough news to talk about in this webinar, we need to talk a little bit about the Farm Bill that got passed last week. So let's give a kind of a first pass, sort of an overview of what we take with respect to the Farm Bill. And there's going to be more analysis on this coming out, not only from us, but from other economists around the country. But just a little update. As you look at the 2018 Farm Bill and compare that to the 2014 Farm Bill, one of the big shifts is the opportunity to make some changes with respect to your use of the PLC program or the Ark County program in terms of price support and revenue support. On the 2014 bill, you had to make a choice for the life of the bill at the outset. With the new bill, you can choose between PLC or Ark County for the first 2 years, 2019 and 2020 crop years. It's a 2-year election. And then starting in 2021, you can make that choice every single year with respect to which of those two programs you find more attractive. So that's a change. A little less challenging with respect to making that long-run decision. That was one of the big problems with the 2014 bill, was you had to project those out years, which was a little bit challenging. So that's a little simpler in that perspective. Opportunities to update crop yields. You can update the PLC program yields, some more details to come. I don't really think we want to get into those details today. We don't really know all the details because USDA hasn't released those yet. There's going to be a change to the way Ark County yield computations are done. They're going to have a trend adjustment in them. I think the bottom line on both of those, on the PLC side and the Ark County side, is the net effect that the yields used to compute potential payments are going to go up and essentially set higher revenue targets, if you will. So we'll see how that plays out, but I think for most cases, if you have an opportunity to update yields, that's probably going to be the attractive choice, but there'll be more information on that later. Michael, you took a look at these PLC reference prices a little bit. You want to walk through
the
that?
reference prices coming out of the 2014 Farm Bill were $3.70 for corn and $8.40 for soybeans, and those are kind of the starting place that we're looking at for the new Farm Bill. The 2018 Farm Bill includes an escalator clause that could be used to boost these reference prices in future years. This applies to all crops within the 2018 Farm Bill. However, having taken a look at those, for 2019 and 2020, the escalator appears unlikely to come into play. And so I think we're going to be having the reference price for 2019-2020 at $3.70 for corn and $8.40 for soybeans. Looking at those reference prices, comparing it to what the Ark County might look like, certainly more analysis is needed, but Jim and I were talking before this webinar here that PLC certainly looks more attractive than it did when we're looking at the 2014 Farm Bill. And so corn producers in particular are going to want to take a very close look at PLC, and that might be your choice for the first 2 years. Soybeans, obviously I'd like to do a lot more computations on this as we get more detail. I think that's going to be a much tougher choice. And the reason is obvious. The $8.40 reference price is even below the prices we're talking about for 2018, right. 2019 with these very large carryovers, whereas $3.70 corn, that's where we're at today essentially, and for 2019 even looks a little higher, and so completely different reference prices there really changes how we look at the comparison between Ark County and PLC for soybeans.
Yeah, and just to put that in perspective, when we did the Farm Bill meetings, for example, on the 2014 Farm Bill, by the time we got the analysis really done, it was pretty clear that for virtually everybody in the Corn Belt, especially the Eastern Corn Belt, that the choice of preferred choice was going to be the Ark County program, and the sign-up turned out that way. Well over 90% of producers here in Indiana, I think actually over 95%, chose the Ark County program. This time, it's going to be a little more challenging to choose between them, and you're going to want to make that choice after doing some analysis, and we'll have more information on that going forward.
And certainly choosing Ark County was a good choice for most producers. That actually turned out quite well. It was an easy decision, and it turned out quite well. This is going to be a tougher decision to make, and it may not play out the same way.
And I guess the good news for producers is that it's going to be a 2-year decision as opposed to a multi-year
decision. Yeah, that's
decision.
huge. We went over that fairly quickly. That's extremely positive, the fact that you can change your position in the 3rd year. And the fact that these yields are going to potentially increase is also very positive. Certainly will increase the revenue guarantee for the Ark County program.
Yeah, very much so. So with that, I think that kind of wraps up our webinar for today. I wanted to remind you about the Top Farmer Conference coming up on January 11th. And for those of you that are watching this on video, I'm going to correct the slide, but I do think I have the wrong web address up there. So if you go to the Center for Commercial Agriculture's website, which is purdue.edu/commercialag, you'll find the opportunity to register for the Top Farmer Conference. And if you're watching on video, I'll put the correct web address on the slide. So thanks for joining us. We want to wish you a Merry Christmas and a Happy New Year on behalf of the Center for Commercial Agriculture. I'm Jim Mintert.